Good morning. Good morning, everybody. It is March 1st. Welcome to March. Happy Tuesday. Happy March. I'm really excited about today's webinar. The financial planning topic has me excited. It's something I just really, I don't want to say learned about. I guess I guess so. I'll give them credit. I was listening to a podcast yesterday as I was driving, and I got so into it. I don't know about you folks, but I like to listen to podcasts, and a lot of times when I'm driving, that seems to be what I'm listening to. But I was driving out the King of Prussia on the turnpike, and I was so into this podcast that I missed my turnoff. And I don't know if you've ever done that, but it's out in that area when you miss the exact turn where you have to go, you end up in this swirl of clover leaves and turnoffs and things. So thankfully, I wasn't late for my appointment, but I was just so into this gripping discussion about financial planning. It was a financial planning podcast that anyway, I missed my turn. And so I want to bring to you, it sparked a lot of thought in my mind about our process and goals, objectives, and how we approach things. So then that topic is I'll just share with you, that topic is going to be what they call a statement, a financial statement of purpose. So that might seem, a little, a little frou-frou or kind of fluffy, but I liked it as the financial statement of purpose. So I'm going to share with you what I put together over the last 24 hours or so, just about of my personal financial statement of purpose. And it's not really a new concept in the scheme of things. When we're talking about financial planning, it's just really identifying it and having something to point back to. So I'm excited about that. Let me, as we're logging in here and I see folks logging in, just do me a favor and raise your hand if you can hear me and see me okay. Everybody, great. Thank you. Good to see you all. For those of you who are clients, we have a really good mix of you who join us every Tuesday. The majority of you are clients, and then we have people who are who either just follow us on a regular basis. And Gerard, if you're on today, I greatly appreciate your message. So, folks, Gerard he lives in New Jersey. I think Gerard came to us from the Ed Slott webinar we did now a while ago. And Gerard is a retired financial planner, registered investment advisor like myself. And he always has great input, and questions for us, and sometimes kind of a layup for me, right? He knows what questions to ask. So I appreciate that. But Gerard left a very nice voicemail, and I always appreciate those. So just thanking us for the work we do and the education. And these, I've shared with you before, these webinars are a joy for me. And I hope you get a lot out of them. I know we go over new topics and new old topics, and listen, this repetition, and I talk about this, learning things over and over again, or hearing things over and over again, is very helpful. So I had an opportunity last week. I was in Orlando, which was wonderful because it was almost 90 degrees and it was just terrible here in Pennsylvania, terribly cold and wet and icy and all those things. But I was at a conference for the insurance broker that we use. So these are always typically very good, a lot of great education opportunities. And this one didn't disappoint. So I was able to take two of our staff members with us, Hamiko and Emily. They're both involved in the insurance process. So Hamiko handles the applications and the processing of the insurances related items. And Emily, of course, handles the financial planning side of it. So it's all combined very closely. But I had an opportunity to talk. David McKnight was there as well. He was one of the presenters. So coincidentally, he was there. It wasn't his event, but he was there. So David and I had an opportunity to spend a lot of time together over a couple of days. And I'll tell you, I am just so you all know that he's coming to join us on April 27th. It's going to be at the old Newtown movie theater in Newtown. And I was downtown in Newtown Borough over the weekend at the framing gallery there, the art gallery, getting some new pieces for our renovated office, which I'm very excited about. The cleaners were in yesterday doing the second floor. It's big space. And then we have final inspection this week. So we're just right there. It's just a couple things. Apparently windows are being made. I don't know where they're being made. I don't know who's making them, but it takes a long time. So we have 2 windows in our break room that may not be installed until about May, but the rest of it's done. So I'm excited to be back in the office. I'm actually going to be meeting with a client this afternoon there. So that's our CPA and the client. So that's all very exciting. But downtown Newtown, I was back to that. We're going to have David McKnight's visit at the Newtown Theater, which is going to be a great venue for this great event. And the local gallery framing place has offered to raffle a painting or a print of a painting of the theater, which I bought one for the office. So really, really neat looking. As part of it, and we're going to do a little bit of charitable fundraising. I'm going to have that framed painting, and then David McKnight's books and Ed Slott's latest book for a raffle. So that'll be fun, and that'll go to the proceeds will go to the Families Behind the Badge, which is my charity that I raise money for every year. That's the one of the charities we were involved with, but this is the one I'm most active with. The Families Behind the Badge is based in Philadelphia. We raise over $1 million a year through a charitable bike ride. We ride from Center City, Philadelphia to Atlantic City. And we have fundraising events starting about now until the ride in July. And it benefits families of fallen first responders. So near and dear to my heart, obviously, being in law enforcement for 21 years and still having many, many friends on the job, as we say. So that's going to be a great event. So get ready for that. We're working out the details on we're going to have a VIP event just for you folks. We're working on the timing for that. We've got people that are driving in from from further away. So and then David, of course, is going to speak and do a presentation, and it's going to be wonderful. So looking forward to that. That's April 27th. Make sure you have that on your calendar. Also coming up, we have Sarah Brenner from the Ed Slott group. So Sarah is the head analyst, I believe, at the Ed Slott group. So that's March 16th. So just about 2 weeks at 6:30. Starting this week, we have our Changing World of Retirement Planning class is starting. It's going to be a webinar. So we have March 3rd and March 10th, which are Thursdays, and March 8th and March 15th, which are Tuesdays. We have a really big turnout for that. We were calculating it. My wife handles that, the preparation for these classes for me. We get registrations of individuals and then their partners, right? Their spouses or significant others. So we estimate it to be somewhere around 60 to 65 people, and that would just be a huge class that's unmanageable. But because of a webinar, of course, it's much more manageable. It's going to be a long class. It's going to be 3 hours. So if you're joining us, make sure we'll take some breaks, but there's a lot of material to cover, as you know, if you've attended these classes live or via webinar. So make sure you have your coffee, tea, glass of wine, bourbon, whatever it is, that's going to make you comfortable for those few hours. All right. So David McKnight's podcast. So I can't say enough good things about David, right? He featured us on his last 2 podcasts. I told you about the first section last week, and then the second section ran the week last week. So I told you about the first one, which was the previous week when we talked last week. And then the second section ran, I think, Tuesday, which is obviously the day we meet. So if you have an opportunity, wherever you hear podcasts or where you listen to podcasts, go to the Power of Zero, and you'll be able to track David's podcast and listen to at least the last 2 where yours truly is featured. And it's a fun conversation. So I appreciate David sharing that. So again, for financial planning, we're going to talk about your financial statement of purpose. So just to remind you, let me go back to housekeeping. Just to remind you, you are all muted. There should be a Q&A somewhere on the bottom of your screen there. If you have questions, you can click in there, type in your questions. Chat should be disabled. And you, of course, are being recorded. And I hope you're watching the videos on the website. So we're getting a lot of hits on certain topics. It's kind of fun to watch on YouTube to see, what's being watched and certain topics that obviously are interesting to people. So if you miss something or you just want to rehear something, go to the website under, let's see what it's under. I have it up here. I'll share it with you quickly. Oh, where am I? There I am. All right, let me share my screen. I see I have a question. Just stand by, I'll get to that. So if you go to the homepage, this should take us to the homepage. That's where you land on our website. And if you go to events and webinars, here you have weekly webinars and there are special webinars. There's nothing under live classes right now because we don't have any live classes, but we have the webinars. So you click into that and you'll see your webinars. The last week's is the most recent. My son helps me edit and post these webinars, and he's usually right on it. They're done in a couple of days now, so that's helpful. He chooses the thumbnails. I have nothing to do with it. And we refer a lot to the charts and graphs that I give you. So that's under this slot corner here, and you just go down, scroll down, and you can download these charts and graphs just as a reminder. There's also a lot of other stuff under this resources with calculators, articles, and videos. So as an example, there's so much information on here. Women in retirement, when markets react, no cash, no checks, no problem, preparing for the ultimate vacation. A lot of really neat little videos that are just part of this website, articles, calculators. These calculators, there's a ton that you can work through. And if you have any questions, give us a call. We'll go through them with you. So I don't want to spend a lot of time on the website, and I need to make that larger. So let me stop share. All right, let's see what question we have before. So John is an existing client, and he asked a question, and this part of the transition, so I'll answer it live. I saw David's name on at least one of the transition documents I signed recently. What is his role? So what John's talking about is some of the annuity documents. For those of you that aren't familiar or just listening, we recently transferred from our relationship with Kestra NFS, which is a division of Fidelity, to Schwab as custodian and Attleboro Wealth Management as a standalone registered investment advisory firm. So with that, we took away the relationship that Kestra had in our what we call hierarchy when we're dealing with insurance. So we use an independent insurance broker named Financial Independence Group. We call them FIG. They're the ones who ran the training seminar in Orlando. And we removed Kestra from that. And as part of that, David McKnight is now part of the hierarchy. So what that means is that David receives an override, which is a small percentage of all business we do through Financial Independence Group. And we have to have one of these groups to facilitate. They don't really hold our insurance licenses, but they help us research insurance platforms and life insurance, whether it's life insurance, annuities, or what have you, but they're independent brokers, and that's important. So we compensate David this way for his Changing World of Retirement program, our ability to use it. And I rely heavily on one of his staff members, Spencer Jablonski, to help us prepare for some of the tax efficiency planning and things like that we do. So it's very much, David, very much a partner and friend, and gives us a lot of great material, not unlike, the Slott group. So we directly just write a check to Ed Slott's group every year to have access to that group. And then, of course, are required to do the education once or twice a year, depending on the situation. But David, we compensated on a different way. So I hope that makes sense. Good question, John. All right. If you have any follow-up questions, let me know on that. But that's why you see David listed on our documents. All right. So let's go into the first portion, which is the Slott updates. I'm sorry, headlines. Let's talk about headlines. So if you're a client, you received an email from us talking about the Russia-Ukraine issue, the attack on Ukraine from Russia. So that immediately put a dive in the market. That can be really unsettling. Now, we did, surprisingly, we saw it recover at the end of the week, or at least close positive. I shouldn't say recover, because we're still below. I haven't looked at a chart, but I assume we're still below where we started this time last week. But listen, this was shocking. And we've been watching the buildup. I, like all of you, woke up to it, I think, Thursday morning. Here we are. The European nations are at war, and Ukraine and Russia. And we see terrible reports, we see terrible photos, and there's been a lot of shining moments from that we see on social media with people supporting Ukraine, people standing up for their country. This is close to home. We have family who are Ukrainian, a lot of people around us, clients my wife is part Ukrainian, therefore my kids are part Ukrainian, and the family, is close. And there's a lot of close ties with Russia and Ukraine, and a lot of Russians live in Ukraine, and there's a lot of half and halves, right? My wife's half Russian, half Ukrainian. So it's a difficult time for sure. And it's certainly affecting the markets and, our oil supplies and all kinds of questions. So that's a big challenge. I go back to the consumer price index, 7.5% year over year. That's unsustainable. This is another big headwind. So the headlines have been challenging for sure. Jumping into the Ed Slott update. So just yesterday, I received this Secure Act regulation update. So I guess it was Wednesday, so just about a week ago, the IRS released the long-awaited Secure Act regulation. So they passed the Secure Act, I guess, going back 2 years ago now. And then there was a lot of questions along the way. And there were some big flubs that the IRS made. The Secure Act eliminated the stretch IRA for most people. And it looked to be, when we first got the regulation, that you had to deplete any inherited IRA unless you fit the category of an eligible designated beneficiary within 10 years, no later than the 10th year the person passes away. But then the IRS came out and said, actually, you need to take distributions along the way. And then it got crazy and confusing. So they corrected that and said, no, we only meant it to say that 10 years it has to be distributed unless you're an eligible designated beneficiary. But now what they've done, they've said, okay, here are the regulations. So they passed the law, and now the IRS came in and said, okay, a couple years later, here are the regulations. So this just came out yesterday. I expect to hear more about it, but there are the biggest one, as I was going through this, that I need to research more. They were talking about first the eligible designated beneficiaries. I'll read to you this paragraph. This is from Sarah Brenner, we're going to be talking to in a couple of weeks. And she is the Director of Retirement Education at Ed Slott. That's her official title. The Secure Act did away with the stretch IRA for most beneficiaries, but those who are considered eligible designated beneficiaries can still take advantage of it. The regulations clarify exactly who is an eligible designated beneficiary. They specify that a minor child of an IRA owner is considered an eligible designated beneficiary until his or her 21st birthday. The regulations also provide guidance on determining who qualifies as disabled, particularly for beneficiaries under age 18. Also, a new documentation requirement is imposed on chronically ill and disabled eligible designated beneficiaries to qualify for the stretch. So that's good. There were a lot of questions swirling around about that. Trusts, we're going to talk a lot about trusts as beneficiaries with Sarah, and I'm going to see if I'm going to talk to her between now and the time we have our special webinar to see if we can also spend 15 or 20 minutes talking about the Secure Act updates. If not, we'll schedule another webinar just to handle that. So trusts as beneficiaries is a big topic now with IRAs. And like I said, we're going to focus on that on March 16th. Beneficiaries hit with annual RMDs and the 10-year rule. So pay close attention to this. So the IRS has taken a somewhat surprising position on the new 10-year rule imposed by the Secure Act. If the account owner dies before his or her required beginning date. Now remember, the required beginning date, or RBD, you see this sometimes, is the April 1st of the year following the year you turn now 72. Don't confuse it with 70 and a half. That was the previous rule. Now it's 72. Yes, it may be 75 but in the future, but right now it's 72. So the required beginning date, or RBD, is April 1st of the year following the year that you turn age 72. So the 10-year rule only requires, so this is if the account owner dies before his or her required beginning date. The 10-year rule only requires that the entire account be emptied by December 31st of the 10th year following the year of death. So this is what we've experienced and what we had clarity on and how we've been working. IRA account owner dies, passes the funds on to a non-eligible designated beneficiary. That non-eligible designated beneficiary has to deplete that account by December 31st of the 10th year following the year of death. Can they take distributions along the way? Of course, but they must by the end of that term, December 31st of the 10th year following the year of death. There are no annual RMDs. However, the new regulations say that if the IRA owner dies after his or her required beginning date, then not only does the 10-year rule apply, but also annual RMDs are required in years 1 through 9. So now the IRS is saying, well, wait a minute, we're going to make this a little more challenging, because if you're 73 years old, let's just say, and you had to take your required minimum distribution the year you turn 72, for the year you turn 72, either you take it by the end of the year or you wait till April 1st, whichever works for you. But now you pass that required beginning date, right? It's the year following the year that you turn 72. Then not only do your non-eligible designated beneficiaries have to deplete the money by the end of the 10th year, right? December 31st of the 10th year following the year of death, but they must take required minimum distributions along the way. So they made that a little more confusing, and we'll spend time on that. But that's an important update. So they addressed spousal rollovers, some details about the 50% penalty if you're under 59 and a half. And of course, stay tuned, because I'm sure there'll be more changes. So lots to talk about the Secure Act, and we'll continue to bring that to you. But that one about the required minimum distributions really stood out to me. So the next one, this comes from Andy Ives. This has to do with Roth conversions and spousal IRAs. So here's a question. This is when people write in questions and the Slott group answers them. So sometimes they're from just, regular consumers. Sometimes they're from professionals who aren't involved in the Slott group. So if an 80-year-old converts his IRA to a Roth account and dies the following year, when can the beneficiary begin withdrawing money tax-free from the Roth? Do the beneficiaries have to wait for the expiration of the 5-year period following the conversion? Great question. This fellow's name is George. So Andy writes back, George, since the IRA owner already paid taxes on the converted dollars, any converted funds will be immediately available to the beneficiary tax-free. Remember, the IRS has ordering rules, right? Contributions come out first, conversions second, and then any growth comes out third. So if you're in that 5-year window and you don't meet the requirements we're going to discuss in a second, then you can get some money back that's tax-free. When it comes to earnings in that same Roth IRA, it's a little trickier. Regarding the earnings, it depends if the 80-year-old ever had a Roth IRA before. So it really doesn't matter that this person's 80. What really matters is if they're over 59 and a half, but it doesn't really matter if this person's 80 or 59 3/4, right? Or 90. If the conversion when he was 80 or she was 80 is the first exposure to a Roth IRA, then the beneficiaries will have to wait the full 5 years from January 1st of the year of the conversion before the earnings will be tax-free. It does not matter if a beneficiary has his or her own IRA. If the 80-year-old already had a Roth IRA for 5 years or more, the earnings will be immediately available tax-free to his or her beneficiaries. That's why I'm always telling you, If you have any thoughts that you want to do Roth contributions or Roth conversions, get it started now, right? Get the clock ticking on that 5-year rule. Just makes things easier. And if an 80-year-old is inclined to have has a Roth IRA, it's probably something they started some time ago. All right, so this is a good reminder. So the question is from a fellow named Greg. I enjoy reading the Slott Report mailbag articles, and I've learned a lot. Thanks. Your recent post on spousal IRAs was timely. We talked about this, I think, last week, and did prompt a couple follow-up questions. So here's question 1. Is the spousal IRA contribution limit $7,000 for a couple age 61? So write that down if you know the answer. Is the spousal IRA contribution limit $7,000 for a couple age 61, so over 59 and a half, or over 50, excuse me. Can a spousal IRA contribution for a prior year be made until April 15th? So can a spousal IRA contribution be made prior to or until April 15th of the following year? Can a spousal IRA contribution be made into a Roth account? There are the 3 questions. So is the spousal IRA contribution limit $7,000 for someone at age 61? Can a spousal IRA contribution for prior year be made until April 15th of the current year? Can a spousal IRA contribution be made to a Roth account? Thank you, Greg. Thanks, Greg, he says. And Andy writes back, thanks for reading. Yes, the spousal IRA contribution is limited to $7,000, $14,000 combined. Assuming both spouses are over 50 and the working spouse has enough earned income to make the contribution. So if the working spouse only earns $7,000, can they make a $14,000 contribution? The answer is no. You got to make over that $14,000. It can be made up till April 15th for the prior year, or the tax filing deadline this year is April 18th for 2021, 2022, and 2021 tax year, 2022 filing year. And yes, a spousal contribution can be made to a Roth IRA. Just be aware of the income phase-out limits for Roth IRA contribution eligibility. And you can find those income limits out of our Wealth Management's webpage. You go under the slot corner, like I just showed you, scroll down, and you see retirement plan information. So let me just check in to see if there's any questions. No questions. Good job, everybody. All right, let's talk about the markets briefly. Then we're going to roll into the financial planning topic. So the markets were down last week, and this is ending February 25th. So I want you to think about this for a second, because this is actually pretty impressive. So we're all concerned about inflation. We're all concerned about rising interest rates. Russia invades Ukraine right at the end of the week, and the market closed down 0.03%. So almost flat. That's pretty darn resilient, wouldn't you say? And the S&P 500 was up slightly, 0.84%. Now the rest of the world didn't look good. -2. The MSCI World, that's the world index, not including the U.S., was down a little over 2%. Emerging markets were down almost 5%. The overall European markets, let's just say, down 2.5%. So everybody else didn't fare as well. NASDAQ was up over 1%. So the resiliency is really something. It also shows trading patterns, right? You see these automatic trading patterns that when there's significant dips in the market, there's computer algorithms that just automatically buy. So that's interesting. For the year, though, we're still down broadly across the board. The Dow Jones Industrial Average is down 6%. The S&P almost 8%. NASDAQ's down over 12%, and globally down 6, 5. Just significant numbers so far year to date. And the bond markets, of course, are down. This is stock markets are down and bond markets are down. -4% for the aggregate bond index. -1.37 for the 1 to 3 year index. So they're all down. That's challenging for your average investors who aren't engaged with someone like us who think that bonds are the safe play, right? Well, wait a minute. I had a friend of the family, contact me, and she's just gone through a divorce. She received part of her ex-husband's 401k through the Quadro process. And she said, well, you look at my statements because he's invested in the safest option. And every time I get a statement, it's worth less. So she doesn't quite understand that because he's invested in government bonds. Why is it losing money? right? Government bonds are the safest out there, right? Well, the problem is that they're invested in mutual funds and they have to be priced every day. So the 10-year Treasury is at 1.96 as of the close of business on Friday. And it hasn't gained much over the previous week. It was 1.93 the week before. BlackRock, to dig in the analyst reports, BlackRock talks about there are 3 items for the week. So they're saying stocks over bonds. So we are tactically upgrading equities or stocks as we seek greater clarity on the Ukraine conflict and reduced risk of central banks slamming the brakes to curb inflation. The S&P 500, they said, slid into correction territory as Russia invaded Ukraine last week, but rebounded afterwards. Bond prices showed declining diversification benefits. So they're saying, to my point, resiliency. So moving money in the bonds is showing that it's not helping with the idea of diversification away from the risk of stocks. In the week ahead, they see the market's focus return to inflation growth and central bank policy. This week's jobs report and euro inflation feed into all 3. I'm not going to read a lot from the Prudential report. I just took from Robert D. Lucia. I just took one excerpt out of here that I like. So he writes, world equity prices have been in a steady decline since the beginning of this year. So equities, again, are stocks, right? So just hear stocks when you hear equities. The rate of decline accelerated in recent weeks, along with the steady buildup of Russian troops on the border with Ukraine. The equity market plunged last Thursday on the news of an official invasion of Ukraine, but staged a spectacular rally and late trading on Thursday and all Friday. The cumulative peak to trough, so the high to the low, decline in stock prices through Thursday's close was 12%, as measured by the S&P 500 index. So that's just one index. So from the top to the bottom in that one day, Thursday and all Friday, 2 days, was negative 12%. So he goes on. So he just gives a little bit of background on that. He goes on to say, the most important question facing investors is whether the stock market decline is a result of fundamental macroeconomic factors. He writes, in my judgment, the answer is no. So that's good news from this one analyst's perspective. Underlying economic conditions are healthy in virtually all respects, including very strong demand for labor, rapid growth in household and business incomes, and solid private sector balance sheets. So you all know what all that means, right? Basically what he's saying is the foundations, right, and he calls it the fundamentals. The fundamentals appear to be strong. It's the news that's driving the activity, because we really don't know. We know what the Fed says they're going to do, but we really don't know what they're going to do. A couple of weeks ago, it looked like, or even last week, it looked like maybe more aggressive, but now some people are saying they may be less aggressive in their interest rate hikes. Real GDP, gross domestic product, is on track to grow at above average rate over the next 4 to 6 quarters, while the risk, so year and a half to the rest of us, while the risk of recession remains low. So I wish I could share his optimism there regarding the recession, but let's hope that he's right. Riverfront finally took a position on something after I haven't included them in the last few weeks or months or so, since they're kind of wishy-washy position on their investments. But they write, the Fed outlook is changing. Investors may not be fighting the Fed, but it may feel like it for a while. They talked about Russia and Ukraine. And their 3 main points are: we believe the Fed is becoming less accommodative as it embarks on normalizing interest rates. The flattening yield curve shows that Fed is no longer quite as aligned with investors. So we're getting pushback from investors, and they've reduced their stock exposure in our advantage. So think about that. BlackRock is increasing. Riverfront is decreasing. I put these in here to show you, these different analyst perspectives. We have reduced our equity exposure in our advanced portfolio to a more neutral level. So who's going to be right in that game? We don't know, right? So that's why I don't believe in tactical investing as a whole like this, because either BlackRock's going to be right or Riverfront's going to be right. And where are you going to put your money? I don't want to bet on either one of those outcomes. That's why we use strategic asset allocation, and strategic asset allocation, principal protection, account segmentation is what helps balance these things out. It's important to read this, and I read these analyst reports and I share them with you because I think that you enjoy the perspectives and to see where we're coming from the decisions we make. But listen, BlackRock's one of the best money managers in the world, one of the biggest for sure. Riverfront, I greatly respect them. Forget about just the last couple of months, but I greatly respect them. They've had fantastic returns over the years. Now, let me pull back on that. We don't invest with them because they're not. They don't meet our requirements, but they've had good results when I knew the folks when they were at Wachovia. Let's just say, I would love an opportunity to invest in Riverfront. They just haven't. They haven't met our marks to be able to include them in the investments every time we look at them, which is about once a year. But I like their research reports, and I liked kind of their philosophy of how they do things. I wish I could invest my clients' money with them. So again, asset allocation, strategic asset allocation, principal protection, account segmentation, and if you throw in there guaranteed income, well, you got it all kind of wrapped up. So as we're moving forward in this year, I told you that's going to be a choppy year. I expect volatility. Listen, we are always defensively optimistic, right? We want to make sure that we're protecting the downside as much as possible. We make sure that you have the funds you need today and over the next for your segments as they're laid out for you. But we want to enjoy the growth as well. So I want to see our markets, the U.S. markets and the world markets, perform well for sure. I don't live in a place of negativity. I don't want that in my life, in my firm. But we have to be defensive, and I don't think there's anything wrong with that. So defensively optimistic is the way I look at it. Read those statements. Open up those statements. These last month statements are going to stink when you see them. Read them. Look at them. We're going through. So we've got a whole new process, well, not a whole new process, but a whole new system that we're working in, right? Schwab as custodian, and we've got Morningstar as our performance reports, trading platform, billing, research and billing. There's all kinds of stuff that we're working through, and I'm excited about some of the changes we're looking at for our portfolios. But you should be looking as well. I'm not a fan of, don't open up those statements if it's bad. You've got to be aware of what's going on. So look at those statements and let's have a conversation if we need to. So now let's get into our financial planning topic. So this is the one that made me pass my exit yesterday. And this is a financial statement of purpose. So we can call this kind of whatever we want. I like the financial statement of purpose. And what it's meant to do is, let me just switch on my whiteboard here because I'm going to share my screen because this is how my son knows where to index financial planning. Okay, so our financial planning topic, statement of financial purpose, and I put in there the why. So it's really, why are we doing these things that we do? Mark and his team make me fill out a spreadsheet every year. Expense, I got to go through my expenses. Some of you enjoy it, some of you not so much. So we look at your expenses. We look at, compared to what you have and how you're drawing those down. And of course, we go through your financial planning questionnaire to make sure everything's still in line. So there's a lot of work that we do. And then you're investing this money, you've saved this money all this time. Why are you doing this? What's the why? And I'm not talking about goals. So every year when we do our financial planning review, and go through that process again, I always say, what are your goals for this year? What do you want to achieve sitting here this time next year? What do you want to achieve? We know your long-term goals, but we want those short-term goals too. And we also want to revisit those long-term goals because they do change sometimes, don't they? And of course, you should do this every single year. But wouldn't it be really great just to have one thing to point to? So I thought, all right, so what is the why, right? So I know my goals. You've all heard my goals before. I figure I'll work until I'm 70 or so. I really, really greatly enjoy what I do. And it's really going to come to a point where, listen, I'm 53 years old. Most of my clients are older than me. There's a point where if I'm 70 and somebody comes to me at age 60, I better have a young person coming in behind me, right? Or they're not going to want to hire us, and that makes sense. But I can work from anywhere. Right now I'm sitting here. It's still in my home office because we're setting up our podcast Zoom room at the Newtown office, which that's fun. I've got a sound engineer guy who's a friend of the family coming in Thursday to help me set that up. So but right now I'm sitting here in my home office outside of Richboro, Pennsylvania. But listen, I could be at a condo in Key West for all you know, right? Or it doesn't matter. And I could be doing this, whole client me. So we could do it from anywhere. And you folks know me. I grew up working on dairy farms and construction. And this work is much different, right? This is not backbreaking work other than the fact that I sit in a chair too much and I've got to make myself walk around, get on my bike, do my workouts, things like that. So I don't, so I'm here when I'm 70. So, but my point is, I know my goals. I'm going to work until I'm about 70 years old. I'd like to buy a place where it's warm. I used to say Fort Myers, Florida. I just don't know if that's the place now, or Fort Myers area. And I have other specific goals. I know what my income goals are. I know what my asset goals are, and those two are directly related. But the question that I have that we're going to start working on with clients is the why in that statement of financial purpose. Here's my statement of financial purpose: to live freely without financial concern, to spend time with my families and friends doing fun things. That's really simple. I want freedom, right? I want to be able to do what I want to do, move it about without financial concern. Listen, folks, most of you are like me. Some of you came from wealthy families or comfortable families. That was not my situation. I'm the youngest of 13. I was working by my own clothes when I was a teenager, 14 years old. It was all about maintaining the household. My father passed away when I was 17 years old. I'm not telling you this to make you feel bad for me or anything like that. I'm just telling you my situation. That was our situation. So we were not wealthy by any stretch of the imagination. We had what we needed for sure. And I have an amazing, lovable, loving, close family, and that's worth everything. But I don't want that going into my current situation or certainly retirement. I want to live freely without that financial concern, because I've had those times when, I wake up in the middle of the night really panicked about things. And I don't want that. And knock on wood, I'm very thankful that that's not our situation today. To spend time with my family and friends doing fun things. That's really simple, but that's what I want to do. I want to do it now, and I want to do it for the rest of my life. Those fun things might be different. It might be when we were in Florida, Hamiko, Emily, and I spent an afternoon visiting a couple breweries down there. I love these, craft breweries. That's a fun day. That's an example. It could also be traveling. It could be just, hiking with my friend, or sometimes my wife, daughter, and I will just end up sitting around reading together. That's fun things too. That's kind of crazy, right? We're reading different books and we're just there together, but that's time and fun things. So pretty simple: to spend time with my family and friends doing fun things, to help my children achieve their dreams and goals. I'm not saying I want to leave each child $1 million. I want to be able to help them during my lifetime and legacy achieve their dreams and goals. So one of my goals has always been help my kids buy their first home. Help them, not spend $500,000 on their first home or whatever it's going to cost then, but help them. So you can see it's really simple. I couldn't come up with just one for myself. Some people, it just might be, the podcast I was listening to, they talked about a client interaction where the statement of purpose was, I don't want to be a burden to the kids. So it could be one thing. It could be multiple things like this. And I'm not even going to say don't go beyond 3. Go, whatever you want to list. Just know when we have crazy stuff going on with Russia, markets are down today again, 494 points right now. It can be positive at the end of the day. But when you're looking at your statements, when you've got us giving you all the work we have to do with financial planning, we're going through all this tax efficiency, paying your taxes early so you help eliminate the tax rate risk when you're in retirement. all this work that's involved, and I understand. I pay my taxes too. I understand what it's like to write that check every year or transfer that money out, and you're like, geez Louise, why does this all make sense? Well, it makes sense because I know in the future I want to live freely without financial concern, and I know the tax rate risk is one of the greatest concerns out there. I fund a cash value life insurance policy. David McKnight calls in the LURP with a long-term care option, right? A long-term care rider, because I know, just like all of us, that I may need long-term care and my wife may need long-term care in the future. So we fund a cash value life insurance policy for that reason. Because I want to live freely without financial concern. That's why I save and invest everything I invest today. That's why. That's the why. That's why I pay my tax. That's why I contribute to a Roth 401k instead of a traditional 401k, when I can get a tax deduction on today on that money, pay taxes less today, and have to deal with higher taxes in the future. I contribute all of my funds, my wife and I, into the Roth 401k for that reason. And that's the why, to live freely without financial concern today and in the future. That's going to also allow us to spend time with my family and friends doing fun things. You see that once you have that, the kind of the guidelines, all the goals build on that, right? So I wrote some notes here. Help kids save and invest. That's one of my goals, right? I want to help my kids save and invest, help my kids achieve their dreams and goals. That's not just me giving them money or leaving them money, also teaching them how to handle it. Make sure my wife is okay if I pass prematurely. There's a lot of planning I do around that, right? She's involved in understanding the business, our real estate investments. She's involved in those because I don't want a situation where, God forbid, something happens to me, because it happens, that suddenly she's left unknowing, right? So that's really, really important. So once you have am I sharing my screen? I am. Okay. Once you have this established, right, then the goals add, well, if we have this, if we have these things going, then let me move this, because I'm doing what I don't like to do and writing up, on the screen here that way. Then the goals branch off of here, right? So goal number 1, right, travel. Well, if we have this, if I'm comfortable here and I know that this is why I'm doing this, and we've got this covered, I'm comfortable with that, then we can travel. We can buy real estate someplace warm. Right? I'm done with winters. You all know me. I've been plowing snow since I was a teenager. I'm done with this. Buy real estate somewhere warm. So why we're saving and investing now. You branch off of that through this statement of financial purpose. So I hope that that's helpful to you. I'm looking forward to working through this with clients and kind of helping understand the why, and just something more easier and more something you point to. Goals are important. I'm not saying we eliminate goals. It just gives us something to build off of, because I think of a fellow who came to me after one of the classes right before the pandemic hit. And he had about $7 million. Now, I don't know about you, but I think $7 million is a lot of money. He had no idea of goals. Even when we're just talking about vision, right? The opening segment of Changing World Retirement Planning is, what is your vision? What's your vision for retirement? Vision for retirement is different for everybody. Here's my vision for retirement. I always share mine. What's your vision of retirement? Because forget about a financial statement of purpose. Most people don't even have that figured out, right? What your vision is. And if you do, you've either gone through the class and the exercise, or you're ahead of the pack. But this fellow really didn't have that except he just said, performance. I want to make more money. Well, why? Well, because that's what we invest for. But is that really what we invest for? Not that performance is the vehicle to get there, and performance is important. We spend a lot of time evaluating our portfolios and making sure that we have the best components in there that we can find at the time, and we change them as often as we need to. But are you really just investing to make more money? And what is the end result? Because at some point, you're not going to be here. And is your goal to be the richest you can be when you're no longer here? I don't know if that makes sense for you or not. But I'll tell you what happened to this individual. This individual was paralyzed. All he was focused on, he didn't have a why for anything. And other than just performance, and he had his accounts everywhere and was Vanguard because they were cheap, Fidelity because they had this big, just and by the way, all good places. But what happened when I met him in, I guess, March of 2020, we were just entering the pandemic, and he put most of his money into cash, $7 million. And I checked in with him throughout the year and a half or so. He did not become a client. It was not a good fit. And that good fit is important, right? If I can't get someone to just get a general idea of why we're doing this work, it's not going to work, no matter how much money they have. So I know for sure that during that time, he kept most of that money in cash. And today, I'm willing to bet that if I had an opportunity to look at his statements, he probably got fully invested the end of this year, or the end of last year, 2021. So that means that he waited, chasing performance. And then, because I know how this fellow thought, he was always looking for that entry. And most people that do that, they just say, okay, geez, the market has sustained all these movements and all this pressure. Now I'm going to get back in, and now here we are down. So if you're only chasing returns without the why, it's really hard to get satisfaction on that if you feel comfortable. But when you have something to point to, it's going to help tremendously. Again, not that performance isn't important, but when it really came down to what this fellow wanted, I bet if he was being honest with himself, it was, something like this: leave freely without financial concern. So, you've got, let's work towards that. If we work together already, we're going to add this into the process. I love it. It made me miss my turn off yesterday. I'm really excited about it. It's just a little tweak. It's not a new direction. It's just a little tweak, something I like. But I hope that was helpful. So we reviewed some analysts' thoughts, market updates, the Slott reports, Slott mailbag, and then the financial planning topic, which is the statement of financial purpose and the why for why we do all this, right? So it looks like I have a question. Let me just pull down. Oh, let me stop share. Let's do it again. All right. So the question is, so this is Richard. He's clarifying my question. Can I contribute to my 401k for year 2021 prior to April 15th to reduce my adjusted gross income in 2021? No, can't do that. You can contribute to an IRA. So the rules for 401k retirement plans and rule for IRAs are different. You've got to do your 401k contributions by the calendar year. And it's good to review those, because you may realize that you didn't make your maximum contributions, and you can everything's got to be done via payroll deduction. So what some people do is they just don't get a paycheck for a month or so. So you got to plan for that. It's better to plan for sure. So the short answer is no, Richard. But thanks for the question. So let me clear that out. Gerard, there's Gerard. Thanks for your kind words, Mark. We aspire moving to Naples or Jensen Beach. Good luck with achieving your goals. So both great areas. So I've expanded my look beyond Fort Myers. I actually just convinced my wife when we were in Key West. And boy, that's expensive down there. But we were looking at places in Key West while we were there. And as we were driving back, she said, I really don't want to have to come all the way to Key West or the Keys, right? There's a lot between the mainland and out there. It's pretty fantastic. But she seems to have been comfortable with the Fort Myers area, but that could go into Naples for me. I love the water, so I'm looking for access to the water for myself. But Gerard, thanks for being here as always. And one of these days we'll meet in person. And I hope it's when David comes to town. So you folks that are a little further out there, an hour or two away, who are listening, we have folks who are in different states, but we got plenty of people in North Jersey or out on the other side of Philadelphia. Come visit. Make sure you make the trip on April 27th. You will not be disappointed. There are plenty of places you can stay over. Make it a night. It's a Wednesday night. Your rates are going to probably be good. There's, if you need a recommendation for an Airbnb or a place to stay, email me. I'm happy to do it. I don't have the room to offer you at my place, or I would, but because two of my kids are still here, and I want, anyway, it was a joke. But I'll happily give you a recommendation, and we hope we can see all of you that day. The theater holds 200. I'm hoping we fill every darn seat because, I know you've all heard David on the webinar, but he is quickly one of the rising stars in the financial, the financial education stratosphere universe, and one of my favorite people in the business for sure, right behind Ed Slott. So I've actually, David and Ed are close. That's how I met David, right through the Ed Slott group. So it's not one taken away from the other. But folks, great to see you. Happy Tuesday. Happy March. We'll see you next week, and we'll see you a lot this month. Talk to you soon.